Well, Dalal Street ended in the red for the sixth straight day this week. BSE companies wiped out investor wealth of over 8 lakh crore rupees in just 6 days. The Nifty and the Sensex erased all their gains from the previous week and fell over 2% each in the week gone by. It was a pretty dismal week for the bulls. That's the only way to put it. On today's edition of the Editors Roundtable, we'll take stock of the sector that has lost the most this year, which is Indian banks, why retail participation has dropped so much, and we'll also take stock of whether the monsoon could hit tractor sales. All this and more in the next half an hour. I'm Sonia, and joining me are the editors Anuj, Nigel and Nimesh. Folks, it's been a rather troublesome week for the bulls, right? I mean, one would have assumed that at some point there would be a convincing pullback, but that didn't really come through.
I think, Sonia, the market actually has been in some kind of a downtrend ever since the year turned. Really the market's been quite negative. It's just that after the budget sell-off, we got some kind of a mirage that the market is on its way to recovery and, the market's headed back up. Actually, what the market did was, because the budget day lows and that red bar was a big one, after that the market had a decent recovery. But what we're trying to do is essentially fill the same gap. And in any case, the markets normally make some kind of, markets always test the bottom to check if there's some kind of a double bottom or not. So the budget day lows, if you notice, on closing basis, we've already violated that. But on intraday basis, we're trying to see if there's some kind of a support there or not. But more than that, I think it's the texture of the market. It saps you of energy. I think a lot of retailers complaining about their portfolios once again. You don't get good feeling looking at the screen, because 1 or 2% fall can happen anytime. But it's just that the nature of this fall, I think this time, looks a bit troublesome to me.
And also, there are no leaders of this market, I guess, right? Yeah. I mean, the banks, which are the main big leaders of the market, have seen a sudden collapse. And we have been also discussing about how that margin outperformance, the loan growth movement could now be behind them, the best of it at least. True. But Nimesh, what are the dealing rooms talking about?
Sonia, if I tell you that the overall sentiment was weak, that will be an understatement. It was sheer fear in the market. A lot of traders have lost money. Investors' portfolios are down 15-20%. And clearly there is panic now from the larger institutions as well as from the retail and HNIs as well. That sums up the mood which was there in the market this week. And that shows up in the volumes as well. If you look at the average cash volumes this week, it's down 50% from the peak volumes that we saw on the Nifty and on the Sensex. So that again shows that the participation was on the lower side. And clearly, that's the sentiment as well. The only positive to me was the fact that the FIs have turned net buyers in the cash market. At the margin, very small, but they are net buyers and they're not selling large. So that's a positive sign. The other feedback is, I was talking to some large investors at the Kotak conference as well this week, and the feedback was, the emerging market is seeing some bit of inflows back, and within emerging markets, there is now dedicated flows into the India-dedicated funds as well. So that actually shows the kind of source which is there for the FI money for India. So that's something to talk about. As you know, Sonia, you pointed out, the biggest worry for the street is the underperformance of the bank Nifty. Both local and global investors, even at the conference, were very worried that despite very strong Q3, despite all the good things, the bank Nifty has underperformed and most of the stocks are down 8-10%. So that's been a big worry for the market. I guess the other important thing to track would be the liquidity. For the last 10 days, there was real squeeze of liquidity for the retail and HN investors. That seems to be slowed out a little bit. There is some change at that level because the penalty on peak margins it's been pushed back to May now. So till now, for the last 10 odd days, there was penalty as well on peak margins. So that's been pushed back. So maybe that's the reason why you're seeing some bit of outperformance we saw on Friday's trade in the broader market. So maybe that explains a bit of that. But I guess from an overall market sentiment point of view, the sentiment is extremely weak and there's sheer fear on the street now. So maybe because there is so much of fear and so much of scare, the market may see a bit of a bounce back.
I think, that's the big question, right? I mean, after the fall that we've seen last week, is this market headed for a larger downside, or are we still talking about just a time-wise correction? What's your best guess?
No, Sonia, look, the point here is that the market is in a downtrend. Now, we don't know when the downtrend will stop. All you can do is just respect the downtrend and respect the screen. And just to give you some numbers, and this week and this month's performance would come for you. The Nifty is down 2.8% this week. The mid-cap is down 1.8%. But the Nifty Next 50, which is where a lot of portfolios are, is down 2.6%. This month, that's down 4.5%. Agreed, some of it is because of the Adani Group stocks, which are heavily populating the next 50 stocks. But the markets are breaking some crucial levels. Nifty and Bank Nifty, like we discussed, the budget day lows were, the closes were sort of dismissed over there. We've sort of tested the budget day intraday lows. more importantly, we're very close to 200-day simple moving average, both on the Nifty and Bank Nifty. And the trend line which you can draw on the Nifty is suggesting a level of 17,100. Since you're asking me where can we fall to, I think 17,100 right now seems like the worst case scenario. Maybe if you can extend it a bit to 16,800, which was the previous low. And one more thing, all sectoral indices were down this week. Not a single sectoral index was in the green. So it was not just one sector leading the market down. And PSU Bank Nifty fell 5.5% this week. Remember, this was the sector which was leading the market. Yeah. And all of a sudden, that's turned turtles. And advanced decline every single day was negative. And this is now the longest losing streak for the market since June of last year. So whichever way you look at it, the trend is firmly down. And my sense is we are headed towards at least the 200-day moving average. We'll be lucky to survive that. Otherwise, 17,100 or thereabout.
Well, let's take that point forward on the banking names, right? You know, not too long ago, we were talking about super credit growth, NIMs looking good, worst of asset quality behind. And suddenly that's gone out of the window. Sonia, tell us, what's causing this pain on the banking names?
So, you know, I just went through some data and I spoke to a couple of analysts as well. And this is what I've gathered, right? First, the data. The Bank Nifty is the biggest loser this year, 7% lower. Anuj was talking about the PSU Bank Index down this month. But if you look at it this year, the PSU Bank Index is down 15%. And all the banks, right? SBI is down 16% this year. Axis, IndusInd, Kotak. SBI, in fact, from its December highs of last year is down almost 20% now. So what's ailing banks? There are three big reasons plaguing banks. One is that the margin expansion that we've seen up until now, it may not be sustainable. The second is that muted deposit growth, right? Because deposit growth has been on the muted side for a while, and that's a big concern which is plaguing banks. And will the stocks continue to fall as the NII growth slows down? Now, here are a couple of views. On the margin expansion front, most analysts believe that the best of the margin expansion is behind banks. Morgan Stanley put out a view where they expect margins to moderate over the next 4 quarters as deposit rates catch up. Now, muted deposit growth is also another concern. UBS put out a report. Morgan Stanley also believes the same, that they are very watchful on deposit growth because of the moderation in CASA deposit growth. And, you know, deposit growth typically moderates in the first year of the rate hiking cycle. So that's an important thing to watch out for as well. So how will retail banking stocks behave as both margins moderate and the NII growth slows down? I asked a couple of analysts. In fact, I had a chance to speak to the analysts at UBS as well, even at HDFC Securities, and they believe that the stocks in the near term, 3 to 6 months, could be under pressure. But in the medium term, 12 to 18 months, is a great time to be buying the banking stocks. In fact, HDFC Securities said SBI and ICICI Bank, after the recent fall, are the biggest beneficiaries, you know, in terms of in your portfolio. Those are stocks that you can look at. Now, the last question I asked them was, what stage of the business cycle are we in? Is it a mature stage? Is it an initial stage? Have we reached the end of the upcycle? And the consensus view is that the banking sector is now in stage 2 of the multi-year business cycle, and return metrics are already at historic highs. So just to give you a number, the Nifty Bank Index is now trading at 2.2 times 1 year forward. It's just above its 10-year average of 2.1 times. So there's no valuation headroom either for the Nifty Bank.
But you know, I was at the Kotak conference yesterday, and virtually everybody was discussing the underperformance of banking stocks. The global investors were asking the clients as to, you know, the Kotak institutional team as to what's going wrong with the financial, so to speak. The domestic mutual funds who are so overbought into the financial space, even they seems to be of the worry, you know, things are good, numbers were better. Even the management commentary, even at the conferences, were quite strong and quite solid. Even then, there has been a big underperformance. So that's been a big worry point as well, not only for retail and traders, but for the larger institutions as well.
Okay, in fact, since you spoke about retail, I just wanted to get Anuj in on this. You know, Anuj, in the last few months, there's been a complete decline in retail customers entering the equity markets, and there are drop-in transactions as well. Whoever you speak to is saying, you know what, I'm staying away for a while. Is it just sentiment? Is it transient? What's your view?
This is called Sach Ka Samna. You know, since, you know, now I am part of Awaz as well, I thought I'll, you know, plug in a bit of Hindi as well, right? But, you know, all those Robin Hoods, all those traders who came in post-COVID and assumed that this is going to last forever. You know, I have a few of my friends who had made markets their full-time profession who gone back to their jobs, by the way, Sonia. So let me do one thing, actually, if I can just go to the big wall and explain it through the numbers. In fact, these are some really nice numbers. The number of retail clients with NSE, that's down 38 lakhs. In last 6 months, 38 lakh clients have actually disappeared from the NSE. They've stopped trading. And the number of NSE clients is now actually lowest in last 8 months. And this is very important. The retail or HNI share in cash market is down to 44%. This number was a mind-boggling 66%. 66% of the volume 2 years back post-COVID were getting generated from the retail and HNI. Now, this is NSE data, but I'm giving credit to a Twitter account, a digital blogger, because this guy really helped me a lot in terms of this data, and it's only fair that he gets the credit. But that's the big number. The other big number, what's happening in the cash market turnover. Just look at that. The daily average turnover, which had reached 81,235 crores in February, daily average, has now reduced to 50,384 crores, which is a drop of 38%. Now, this doesn't mean that people have lost interest in stock markets. People have lost interest in investments. But there is some interest in market overall. Look at what's happening to the options turnover. This is the index options, and we're only taking premium into account, not even the overall notional turnover. The premium, which used to be 17,485 crores in February, that's gone up to 53,562 crores, 206% growth. No wonder the SEBI is a bit worried, especially considering that 90% of F&O traders actually end up losing money. And that's why this data is very important. And now the reason for that, because from October 2021 peak, the market's not given you anything. The Nifty is down 5%, and that's not even telling you the true picture. The Nifty mid-cap is down 8.2%, and the Nifty Next 50, which is where, again, a lot of portfolios are benchmarked to, it's actually down 16%. And equities are not giving you a return. The other thing is happening. Remember, in 2021, the fixed income market was not giving you anything. The repo rate was 4%. Now repo rate has gone up to 6.5%, and it's still rising. And what fixed income is giving you is it's generating risk-free return of 7 to 8%. So when you can get 7 to 8% risk-free, why do you want to be in an asset class which is actually giving you minus returns and, you know, raising your blood pressure? I think that's maybe the reason that a lot of retail is moving away from full-time investments and back into their jobs.
Okay, you made us feel really bad, Anuj. You made all investors who are watching you now feel really bad about how they've made no money since October of 2021, and maybe fixed income was a better place to be.
You know, statistics, what they reveal is very interesting, but what they conceal is vital. Yeah. So, of course, this has been actually a perfect market if you could get into right kind of stocks. A lot of people would have made a lot of money. But what we're talking about is averages. An average investor would have lost money. And the fact that post-COVID, you thought this is an ATM where you could walk in every day, just put your card, take money out, enjoy, those days are over.
Okay, well, let's do one thing. I think we had a conversation with Zerodha as well. Shireen spoke to Nitin Kamath, and he was pointing out exactly this. He said that the new users have dropped drastically, and the company was finding it hard to generate revenues with existing users as well. Listen in.
Even in broking, I think I somehow feel that we've kind of hit a plateau because the new user growth has dropped. The existing user growth, existing users aren't really, adding more as such. So I think the big challenge is that while India is a large country, we're still a poor country, and the real problem to solve in this country is to kind of get rich inclusively. Get a lot more Indians, to a position where they can actually spend money.
Okay, let's do one thing now. We have a guest joining us. Devina Mehra is the chairperson and managing director of First Global, someone who keeps a hawk eye on both the macro and the micro issues related to the market. Devina, good evening. Thanks a lot for joining us. Now, you had been raising this point for some time that the market was getting ahead of itself in terms of that rate hikes in the US. And this week has been a bit of a reality check for not just US markets, but back home in Indian market as well. How do you see the current market situation?
Good evening. Rate hikes, I was never of the view that we will see a peaking and then a decline very quickly. So that now is becoming clearer. And the market also now is not really pricing in declines in the second half of 2023, as was the case earlier. So that's from the US side. But no, as far as markets are concerned, I always say that you have to separate the economy and the market. So from the last quarter of last year, I had been saying that you have seen very, very poor numbers in global markets for the first 9-10 months. And that if you look at the year as a whole, also 2022, was one of the worst years ever in asset markets around the world. Even if you take perspective as long as a century. So it was the very worst year in almost 230 years for US bonds, for US equities and bonds going down together. You saw that in 1931 during the Great Depression, 1941 during the World War, 1969, and then 2022. So I had said, while the bad news on the economy is not over, probably a lot of it is priced in. So if you look at this year, NASDAQ has been one of the best performing indices so far. So it is up more than 11% for the year. So in spite of all these rate hikes, which supposedly then impact the growth companies more, the point is that it was among the worst performing indices last year. So the cycle always turns, and the market often is ahead of the economy. So it is not only what is expected in terms of either the economy or even corporate results, but what is the market pricing in? That really is the question you always have to ask yourself.
Okay, and that question is valid when it comes to banks as well, right, Devina? Thanks for being on the show. As they say, you can never really catch the bottom. So do you think this is a good time to be buying banks, even if it's going to head southwards from here, maybe 5–10%? Is it a good time to at least start nibbling?
Well, we started nibbling at it about middle of last year, middle of last calendar year. So we were always a very, very low weightage on banks from 2020 when we started our PMS right up to the middle of 2022, which served us well because during that period, banks underperformed hugely. 2020, that was the only index in the red, only industry index in the red. In 2021, it went up only half as much as the market. So in 2022, both in terms of a trend change and as often was discussed, there were some fundamental changes also from the NPA cycle being behind them to the rate hikes. And the story was playing out fine till this whole upheaval, which started with the Adani news. And I think that is really what hit the banking sector. I mean, now we are finding some more causes to explain the fall, but I think really the trigger has been that, and at times overdone because it hit all kinds of banks which have nothing to do probably with having a group exposure there. So I don't think the story basically of whatever one thought of banks 3 months ago has changed drastically. We would be about market weight in banks and not hugely overweight, not hugely underweight.
Okay, well, on the fence then, perhaps. Not hugely overweight, not hugely underweight on banks. Got that. Devina, just stay on. We need to take a short commercial break, but lots more coming up on the other side. The other story we're focusing on, will El Nino jinx India's monsoon, and will tractor sales hit a break this monsoon season? That's coming up in just a bit. Stay tuned.
Welcome back to Editors Roundtable. Well, the other focal point is the tractor sales, and that's been doing very, very well. A few years ago, we were doing around 500,000 odd. Now we're on the verge of doing close to around 1 million units odd. The question is, will this speeding tractor come to a halt, or will there be a break that's put in place? Two factors playing out here. One is fear of El Nino, and the second factor is in a post-election year, we normally see some bit of pressure. Let's focus on the first factor then. El Nino remembers when the waters in the Pacific, they cross the 24.5 degrees odd. That's what affects the southwest monsoon and in turn hits the rainfall here in the subcontinent. Now, India in the last 22 years, we have never seen 5 straight good monsoons. We have had 4 straight good monsoons. So let's see whether or not we can break the jinx. The hope is maybe, in fact, we break that jinx. But the odds are stacked against us, particularly in an El Nino year, because some statistics suggest that the chance of getting excess rainfall is almost zilch. Below monsoon, there's a high likelihood, and there's also a high likelihood of a drought. Clearly, that could impact tractor sales. So that's point number one. The second factor is, in a post-election year, we have seen that it dips a little bit. And remember, in a run-up to election, you have loan waivers that's hoped for. You have agri-loans dispersals that pick up. And also a lot of these bridges, and other construction sites, they do see a completion. And 35% of their transportation, well, it finds application via tractors as well. So that could be one of the reasons why in the run-up to election, you normally see that, tractor sales are pretty good. So let's get that graphic plate up for you. In 2014, we had very, very good growth. But in the next couple of years, we saw a bit of a degrowth. Similar is the case in, in 2019. In the following year, we saw a bit of a downtick. So last two elections as well, the following year hasn't been very, very great. Let's hope it doesn't happen this time around. But two risks. One is the statistical risk that we are putting with regard to the numbers in the last two elections. And the other one is the fear of El Nino, which could be on the economy, markets, as well as tractor sales.
Well, Nigel, it's an interesting piece that you've put out. I just want to ask Devina the same thing. There are concerns about El Nino. There are concerns about heat wave as well. You've seen some bit of traction in the white goods stocks, Devina. The likes of Voltas doing good despite weak numbers. This week we saw a big move in Whirlpool as well. Any thoughts on the white goods space? Anything that you like and you've been a buyer there?
We might hold one or two stocks, but that's not been an area. Of course, it's a relatively small sector also, so it's not something we focused on a lot. And this weather bit, one will need to think about. Of course, it's hard enough being an expert in the. You are supposed to be an expert in, and to try to be an expert in weather or something is another dimension altogether. So,
especially at a time like this, right? Devina, I don't know what's happening in Dubai, but in Bombay, at least every other month is a weather change, right? You don't even know what season it is anymore. But, I mean, jokes apart, anything else that you like in this market? I know it's very difficult to find alpha now with this market all over the place, so much volatility. But any spaces, any pockets that interest you now?
Right. So, of course, ours is a very diversified portfolio. So we do manage to create some alpha. I was looking at our small case, for instance. I think roughly about maybe 15, 16 months, market is down 4, 5%. We are up to 3%. So not, obviously not up 20%, but still that's a reasonable alpha. Right now, in our last rebalance, one sector we've added a bit back on is IT services. So we had, like, with various changes over the quarters, we have become underweight. Now we've gone slightly overweight. We might go even a little more overweight there. And that's a sector that, of course, has been performing also of late. So that has been providing some of the cushion from where the banks have gone down. So that is one. Another, we added a couple of pharma names also. Capital goods, industrial machinery, I've spoken about earlier on your channel also. That is something almost a year and a half ago we went overweight. And while we have booked some profits since, we would still remain overweight, especially relative. The index, it's not such a big weight. So we still continue to hold many of those stocks. Though, as I said, we booked profits as well because some of them have doubled and tripled as well.
All right. Hi, Devina. In this sort of a market, what to buy is important, but often what not to buy is important. So what's something that you all are completely avoiding in terms of a sector? Maybe it's the new age theme. There were some hopes out there. They ran up a little bit. But, some of them have come down as well from the top. So what are you all avoiding in this sort of a market?
Yeah, so the so-called quote-unquote new age stocks we haven't yet kind of dabbled in. Yes, they have been going up and down, but we are still watching that. So that oil, energy-related stocks where we had something earlier, I think those we would be underweight now. So odd sectors like that. But mostly, we of course look at bottom-up. So, for instance, we might be a little overweight still chemicals and textiles, but that's not a sector call, it's more a stock call. And that's the way we've done it. FMCG also, for instance, we started with our FMCG kind of dipping our toes in with ITC last year, roughly, I think exactly about a year ago or so, maybe 11 months or so.
Right. Sure. All right, Devina, we appreciate your thoughts. Thanks a lot for joining us on Editors Roundtable. And with that, it is a wrap. But folks, what's the weekend plan?
I was actually waiting for this question. I just went up with
but do you have
weekend
a plan?
plans. I actually don't have any plans. Sorry.
Then why were you waiting for the question?
No, I was waiting for a question because you'll keep asking every Friday, and I keep answering that. No, sorry, I don't have any plans. But Nigel, any support to UB, USL?
No. I've entered the period where there's no support, 1.5 months. Or
then I think
maybe a trek or something.
Then, I believe.
Anuj has the most exciting weekend plans these days, right?
No, I think I'm planning to watch this web series. I've heard some good reviews about it. It's Fuzzy.
I watched it, by the way. It's
I
amazing.
watched it.
Absolutely.
So I think because there's no match, there's no movie, so I think I'll go with that.
And you know, people talk a lot about Shahid Kapoor. I think that Vijay Sethupathi, he's amazing in this series, and I think you should totally watch that. All right, guys, have a great weekend. You know what to do with your time if you don't have any plans. And we will be back bright and early on Monday. Thanks for joining in.